Well, I think if there are a couple of slightly complicated graphs. Done a lot of work this year. I'm working with a couple of guys in the States. We're trying to put together a package of investment approaches that will deal with the new world. Basically, if you think about the period from sometime in the mid 80s up until the COVID outbreak, we had a world where everybody kind of knew where the limits were. We have had a few crises in it, not least the GFC. But in macro terms, that was kind of a one-year wonder. And everything then settled back to the same sorts of ranges, the same sort of volatilities and variations, the same sort of correlations. You could do the same trading pattern. We've had a whole generation grow up, and 2 generations, if we go back to the middle 80s and talk about us old salts, who haven't seen anything different. And arguably now we've broken the corridors, we've broken the bounds, we've let the beast out of the box, and we're going to have to deal with a world where not only do prices spike up more rapidly, but also then when the central banks and or the fiscal authorities start to panic about it, they'll collapse back, and all the extra activity based on that hot loose money and easy government will struggle, and then we'll go again. This is exactly what we did through the 60s, the 70s, and into the early 80s. And the argument is that's where we are again, and we need to look at new investment approaches.
Go on. You've hooked me in, Sean. What are the new investment approaches?
Well, the new investment approaches aren't formulaic. I mean, there's no, in this world, there are no models. There is no, the quant strategy of mining for this, that, and the other, and so on and so forth doesn't work if correlations are breaking down and if politics is becoming reactive, and if what the Americans call the OODA loop, the observation, reaction, response, gets faster and faster, but less and less effective. So we have much more hysteresis, much more volatility. It doesn't necessarily mean inflation roars away to 20, 30, 40% in the developed world, but it goes high quickly. And then we have to have a response, and it dips back. And as soon as it dips back and we start to see stress either in debt markets or employment markets, the relaxation comes, and the virus hasn't yet been purged from the system, so we go again. So in that environment, you've got to be very proactive. You've got to look for sources of resiliency. You've got to look for the famous people who are selling the shovel to the gold miners and so on and so forth. So there's no real prescription, but it needs a different mental approach to begin to search for what you should do.
I mean, are you advocating some form of high-speed trend following, effectively, keeping a very close watch on different asset classes and sectors?
Yeah, but also I think you're looking for elements of mispricing. You're looking for value and anti-value, I think, as well. You're looking for the sorts of companies that can pass costs on or can expand because their product is now more scarce than it was, possibly because a competitor has either priced out of the market or fallen out of the market, and things like this. So yes, it is much more discretionary. There's a macro background to it that you need to look at to see how these changes are coming about and what the responses are. But I think the top layer is very much searching for the nuggets among the dross.